Hello, good evening. I'm going to talk about mortgage in the UK and uh, what people call buying a house. And I hope that in this video you are going to be able to make an informed decision on whether to go for it or to consider something else. So, like in any other conversation, I'm going to start with the advantages of having a house in the UK or getting into a mortgage contract. Or, in fact, I'll start by explaining what it means. What happens is you go to the bank, you approach any bank which is reputable, and then you present your case, present your papers, present your earnings, present your credit score, prove your credit worthiness, prove your earning income, your earning capacity, your right to live, especially in the UK, that you are living legally as a legit resident. You don't even need to be a citizen for you to be able to get a mortgage. So what happens is the bank is going to look for a house for you, and like in an area where they think they are good houses, because different banks specialize in different types of houses. Some do farms, some do retail, some do commercial shops, some do new build contract houses, some do old houses which are much cheaper. But some banks will go for expensive houses like new builds because they are cheaper to maintain. So the bank will tell you, we've got these offers, or please, or we've got these contractors or agents, please look for a house. And we are willing to sponsor you a certain amount of money, like £200,000 or £250,000, based on your income or your savings or how much deposit you have got. Say they tell you that you are going to offer you £2,000 for your mortgage, then you have to look for a house which is worth that much. So when you find that house, you notify the bank. So the bank is not going to give you the £2,000 in cash in hand. No, they'll pay the housing contractor or the developer or the estate manager or whatever, or that housing agent. They pay them that 200,000. They buy the house for you. Then they loan you the house. They lease you the house in monthly installments. So instead of giving you the 200,000 to spend and then you pay them monthly over 35 years, they'll give you a house and then you pay the monthly, maybe installments of £1,000 per month for 35 years. That's how they put their loans, or that's how they give out their loans. So that's a good deal. I'm going to talk about the advantages. So the first advantage is it's so difficult to rent a house in the UK, especially with our African families that maybe the husband is not working, is taking care of the children. Because when you approach a landlord and they're looking for a house, they'll ask you how many adults do you have in the house, and then you say two. Okay, so where does your husband work? And then you say he doesn't work. That's a minus mark for you. It's difficult for you to give you that house because one of you is not earning. It's only one person who is earning, even if you're earning a lot of money. But they need both adults in the house to be earning. But because of various reasons, you may not even be both of you be working, because we need someone to take care of the children, school run, take care of the house and stuff, because we have our African settings. The next thing, you may fail to get a house to rent because you've got children. Most landlords will say no children. So most children will say no children. Most landlords will say no children. So if you've got children, of course, we're Africans, we do have children. Not even 2, 3, 4, 5, 6 children. So it will be difficult to get a house to rent because you have got 4, 5 children. I don't know why they don't want children. Maybe it's because of the maintenance of the house that children will be like scribbling on the walls with crayons, banging doors, breaking windows, blah blah blah. I don't know, but they feel that it's way more expensive to renovate or to refurbish a house where children have been living. But I don't agree with that. But what can we do? So if you have got your own house, like your own mortgaged house, I still find it so difficult to call it my own house because I wouldn't have fully paid it up. But for the purposes of this video, I'm just gonna call it my house. All right. So when you own your own house, which you have mortgaged from the bank, you'll be able to stay freely with your children. You'll be able to do stuff like even invite people from church. You have weekend birthdays, weekend parties. Your family can visit from Africa, friends can visit. Because in some houses, you cannot have a visitor come and visit you or stay overnight without informing the landlord, or even someone to visit from Africa without informing the landlord. You have to notify the landlord that someone is coming. There are so many rules. You can't even put a nail in the wall. You can't even hang picture frames and stuff. Or like a lot of things that you can't do. There are so many rules and regulations if you are a tenant. So if you are living in your own house, you've got that certain degree of freedom. Then if you've got that house, the bank has trusted you enough to give you a mortgage. It means you are a trustworthy lender. Yeah, lender, I think is the correct. Lender, I think is the bank or is the person. I don't know. All right. You are a trustworthy customer, right? So it means you qualify for equity from other institutions. You qualify for other credit or loans from other institutions. Other banks can give you loans because the bank or even Barclays Bank or NatWest or whatever bank is rated you as a trustworthy customer. How can you loan someone £200,000 if you don't trust them? Obviously, it means you are trustworthy, you are credit worthy. That's the word. So you can also use that same house, which you have been given by Barclays Bank, as equity to remortgage another house. I'm not sure how about the values of how much value you can get and stuff. I don't know. But you can use it as equity to finance other projects. All right. Get other loans and stuff. I don't know how that works, but someone told me that. Then there are other advantages that you have a permanent address. Having a permanent address in the UK is gold. Because the moment you change your address, it reduces your credit score. You have to change your driver's license, you have to change your GEP. You lose a whole lot of information. You have to update your DBS, you have to update this, you have to update this. So if you've got a permanent address, it's an advantage in the UK. Say you've got a husband or a spouse who is into business or wants to open a company or whatever. Because if you are a dependent in the UK, you are free to open your own company. But one of the most important requirements of a company is having a permanent address. So if you're renting from a landlord, you cannot use their address as a business address. But if it's your house, yes, you can register it on your company as your permanent business address. Of course, you may not be fixing cars and doing your carpentry and welding at the house. You can be doing it somewhere else at the garage. But for communication, text and whatever, or other form of communication, or website or whatever, you can use that address for company registration and everything. Because you cannot put the address of the garage, because most probably you are renting from that garage and you're gonna be moving once a year or every 2 years from that garage. But you can use your house address as a permanent address. That's a plus for business people. It increases your credit score. I've already mentioned that. Then, it's a form of savings. That's the golden one. Why? Because if I'm staying in the UK and I'm paying rent, like 1,000 every month for 12 months, that's 12 months gone with no refund, no recourse. 2 years, that's 24,000 gone, no refund, not even a cent of it will come back to me. But if you've got a mortgage, it's some form of saving in your name. I'll talk about it when I talk about the disadvantages. That's when you get to understand why I'm talking about what I'm saying about this. But on the advantage side, on the plus side, having a mortgage and paying the monthly installments is a great way of saving your rental. Okay, now I'm going to talk about the downside, the cons of why I will not personally go for a mortgage. Why? Okay, I would say one more advantage, right? explain better further about the permanent address. One time you may need to go to back home, like to Zimbabwe, Malawi, Kenya, wherever you come from. You will need to come back to the UK, maybe for medical treatment or for education, or to leave your children. Like some of us were old, we need to go back home, but we need to leave our children here going to school and stuff. They need a place to stay. So if you've got a mortgage, your children are guaranteed to have a place to stay. And another advantage, the advantages keep coming. Another advantage is that you can, let's say, you're paying maybe, let's say, £800 as monthly installments for the mortgage. Then you decide to go back to Africa, India, or wherever you come from. Then you put in a tenant who's renting the house, and they're paying maybe £1,200 a month to you. It means from the 1,200 you pay 800 to the bank, to the installments, for the monthly installments. Then the other 400 you use it for your own personal use in Africa, like for whatever you need. And you know that £400 in Africa is a lot of money. It can take you places, literally. Yeah, it's a lot of money, which can help you like with whatever you are doing in Africa. So it is a great way of earning passive income, like active income, really. So now I'm going to talk about the cons, the disadvantages, the downside of having a mortgage. Fine. So first of all, most of us, this place is not our home, although we would like to call it home, but in earnest, it is not our home. One way or the other, we will need to go back to wherever we came from. That's the honest truth. It may be today, it may be next week, it may be next month, it may be next year, it may be in the next 10 years, it may be in the next 20 years, but definitely we may want to go back home. We will want to go back home. But having a mortgage means you're tied down. Like, you're committed, of course, because you have financial obligations to pay those monthly installments, to make sure everything is fine, because you've committed to a capital project. Okay? So if I had worked this year and I saved 10,000 and I paid for my mortgage, right? It means I have to work some more. I've taken those savings and deposited a mortgage, right? I have to work 1 more year, 2 more years to get money to go home with, because I've already emptied my savings. So that means it's a prolonged time of commitment, trying to recover the money you have used for the deposit. 2, you may need to work hard or harder, because you are mandated to ensure that monthly installments are in the account. So you cannot like take a lesser job where you earn less, because you were granted that that loan of 1,000 a month for the mortgage, because you are earning a certain salary. So if you decide that I want to cut my contract to 2 days a week, meaning that you're going to be earning £800 or £600, it means you're unable to meet your financial obligations of paying that monthly mortgage of 1,000 a month. So it means that even though you're not feeling well, you still need to work to meet your financial obligations. But some people will argue and say, if things are not well, you will have personal insurance, which will pay off your mortgage and stuff in case of ill health. But how much is ill health? Maybe you need to be bedridden and to be on a ventilator in ICU for them to consider you to be a candidate for ill health exemption or whatever. But as for me right now, I'm having ill health. I can't cope being at work. I'm stressed, but I'm fine. My arms are working, my legs are working, everything is fine. But I just can't continue going to work because other emotional stressors and stuff. My legs, maybe the knees, like slight arthritis, back pain and stuff, and you feel I can't work more days. But obviously you can't go to the insurance and tell them that you need to pay off my mortgage because I've got anxiety if I go to work, or my back is aching a little bit if I stand for long hours in theater. They won't take that. So I think it's kind of debatable, the issue that insurance is going to pay off your mortgage. I'm not sure how that works. I've not done that. Then, like I said, you have emptied your savings. You've taken that 10,000 and paid the deposit. It means that 10,000 pounds is tied up in this capital project. There is no way you are going to withdraw it overnight. Unlike having your money in the bank as cash, £10,000 in cash, it means it's tied up in this house. All right, which brings us, like, definitely mortgage is not an investment, so there's no way that this money is going to generate income for you, this 10,000. A typical example would be, if I take that, if Mary takes a 10,000, she buys 10,000, how many cattle can it buy? Average of about, let's say each cow is averaging 500 US, a real proper cow, not our hard mashona thin cows all with skin and bones. I'm talking of a real cow, right? The cow costs 500, so 10,000 pounds is gonna get you about, is it 200? Wait, 1,000 will get you 2 cows, 10,000 will get you 22 cows. All right, next year, if all those cows, all things being equal, there's a fat bull, a strong bull is able to service them, or whatever you do, artificial insemination, whatever. Next year, this time, those 22 cows will be 40, all things being equal. In the third year, those 40 cows will be 80. In the fifth year, those 80 cows will be 160. In the sixth year, those 160 cows will be 320. But there is no, that's about 500, 600, 1,000% profit. Your money is doubled, tripled, quadrupled, and everything. But when you put in your 10,000 into a mortgage, there is no way that 10,000 is gonna spin around and give you about 50, 60,000 in as profit in 5 years, because you continuously have to pay every month, which means mortgage is not an asset or an investment, because you're continually paying from your pocket. So it is a liability. And to make matters worse, it's a long-term liability, which is, in most of the contracts are 20 years, 25, 30, 35, 40 years. And like me, I'm almost 40. Imagine getting into a 40-year contract of buying a house. It means when I finish buying that house, I'll be 70 or 80. And if I need to finish early, like maybe when I'm 55, already it's late for me, 55 or 60, I have to work twice and pay twice as much the installments. Instead of paying 1,000, I have to pay 2,000 every month, which means I'm working harder if I am to enjoy staying in that debt-free house. So those are the complexities of mortgage. Then it depends on the type of contract you have. Let's say it's an old house which you have bought. You have to do the renovations on your own. But some new builds that I've seen, one of my friends bought a new build, and part of the contract was they do the repairs. The agency does the repairs and the maintenance, cutting the grass, repainting the walls every year, fixing leaking taps, or whatever damage happens to the house. They are liable, they'll take care of it for the next 5 years. But after the 5 years, what happens and how much does it cost? And you know, most of these houses in the UK are made of wood, timber, boards and stuff. They are different from our African houses, which are made of steel and asbestos and bricks, concrete and mortar, which are way more durable. My landlord fitted in a new tub, just a tub, not a whole bathroom set, just a tub and an overhead shower. It cost him £3,500. I felt sorry for the poor man. Consider if it had been my house. I've gone to Africa. I'm enjoying those other profits which I spoke about, the 400 every month. And the landlord, the tenant calls me, I'm in Africa, and says, "Oh, Essie, your house is leaking. I need a new tub and a new shower." And I have to fork out 3,500. But of course, they talk of insurance, housing insurance, blah, 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 blah. Like insurance was going to pay for the renovations and stuff. But I don't think it's that easy to get them to pay that much money. I don't know. Because my landlord had to pay from his pocket. I don't know why he didn't use that insurance, because people in the UK always say insurance will cover it, insurance will cover it. I'm not really sure about insurance, please pardon me. I'm talking of just facts as they are and what I've encountered. Then, like I said, that all of us are eventually going to go back to wherever we came from. I said paying those monthly installments are a form of saving, monthly savings. So I've paid 10,000, which is the initial deposit. Then every month I'm paying 1,000, 1,000, 1,000. By the end, up to December 2025, I've paid a total of £20,000 on the mortgage installments. Some people say we're going to sell the house and get my 20,000 back, and then I take the 20,000, I go home, I start my cow project, like what you were saying, or growing mambaira, or growing potatoes, or whatever. But it doesn't work like that. You're not going to get your 20,000 back. Why? Because you signed a long-term contract which states that you are going to be in this contract for the next 30 years. So a breach of this contract, saying you want out because you want to go to Africa, it's got some penalties. I don't know whether it's 1,000, 2,000, 5,000 or 7,000 pounds. I don't know. I've not done it. But definitely there is a penalty. Fine. Next, you can only sell the house like at a full cost. Like sell the house is 200,000, remember? And maybe it has gained some interest, like value, appreciation. It's now 220,000 after the 1 year. Because houses, they gain 2 to 5% per annum in interest, depending on the annual inflation rate and other economic factors which are in the country. Say the house is now valued at 220. You need to sell the house for that amount. When you get that 220, then you pay off the bank. You take your 20,000 and give the bank their remaining 200,000. So that's how it works. But where are you going to get someone who is going to buy the house for 200,000 pounds cash in the UK? I don't know. Because how can someone buy a house for 200,000 pounds cash when banks are still offering mortgage for a deposit as little as 5,000, 8,000, 10,000 pounds? So who is going to buy the house? And you want to go to Zimbabwe, you want to go to Kenya, you want to go to Ghana, and you want to sell your house to get your 20,000 back so that you can go and start your poultry project. How many months is it going to take for you to sell that house? How many years is it going to take for you to sell that house and be able to pay off the bank? So if you cannot sell the house, the bank will repossess the house. I'm not sure if they're going to give you back your money. I still have to research on that. But they will repossess the house. Okay, all things being equal, let's say they have not repossessed the bank, whatever. You found someone who is willing to buy the house, blah, 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 blah. But what I want to tell you is there's what they call capital gains tax. UK is a country which specializes in tax. So they will take 40% capital gains tax and another amount of stamp duty. I don't know how much percent is that. Maybe I'm mixing up the percentages. But what I know is there's capital gains tax, there's stamp duty, there are legal fees, notaries and conveyances and everything. Then the processing fees and everything. Then the penalties for pulling out of the contract before the agreed time. So I'm not sure out of that 20,000 how much you're going to remain with. But maybe 5, 6, 7, 8, 9, 10,000 is what you're going to get out of it if they're going to give you back your money. So if they are going to give you back that 5,000 or 10,000, that's a form of saving. You go back to Africa with something as compared to someone who has been just paying rent without paying monthly installments. So that's the other disadvantage, that a house is not liquid. It's not a liquid asset that you can convert into cash overnight. There are a lot of nitty-gritties which are involved, which will take time, which will take money, which will take technical expertise for you to be able to liquidate that house and change it into cash. Then I mentioned that it's a long-term commitment. 30 years, 40 years. By the time you finish paying the house at 60, most of us will be 60, 65, 70, or 80 by then. And we know how the system works. When you are 60 or you're unable to take off yourself, the government will have to take the house away from you. They sell it. When they sell it, they pay for your welfare in a safe place such as a care home or supported living or whatever. Unless the house is in a trust, like a trust that it's in the name of whatever, and the government cannot take it, what. But I don't know if that works. I don't know. Because I've seen many people just selling their houses and going to pay for their services in the care homes. Then, if it's not a trust, you cannot transfer the house to your children. Because if you are transferring, let's say it's different from Africa. When I want to transfer the house to my children, what I have to do is just go to Zimbra or whatever taxing company. I pay, I think it's 5% or 2.5, I'm not sure how much, 4%, like the transfer charges in Zimbabwe, like the duty or the tax, like the tax for transferring capital gains trust is not as exorbitant as in the UK. So if you are going to be transferring the house to your children, you have to be willing to pay tax of about 40 to 50% tax. And I've heard that there is a rule that if you happen to die today, this is February 2025, all the transfers, transactions, property, cash, and everything that you did in the past 7 years, they are bound to be reversed. And the state takes over. So I don't think the houses in the UK are really safe for us to say I've invested for my children. If you really want an investment for your children, buy a fully paid up house in Africa or in India or wherever you come from. That is what you can say, this is a legacy for my children. So having said that, it's up to some, and also it depends on how long you want to stay in the country. So factors that influence whether you are going for the mortgage or not is, what do you have to lose? What do you have to gain? What is it that you value? Are you a business person? Are you interested in investing and multiplying your money? Or you want just comfort? Some people are not interested in, not everyone is an entrepreneur or a business person or is interested in investing back in Africa because they don't intend to go back to Africa. So it's better they pay for the mortgage here. So just know where you stand and what are your plans. If you are here to stay for just 3 years, 4 years, 5 years, I don't think it's a wise idea to commit to such a lengthy project such as a mortgage. It's better you take your money, do your things on your way out as part of your exit strategy. Build as many houses as you can back in Africa instead of tying up your house in a 35-year-old contract. Then the other thing is, are you an investorpreneur, someone who wants to multiply their money quickly? If you are, there's no way you're going to take 10,000 and you tie it up in a capital project which is not going to give you any returns in the near 2, 3, 4, 5 years. You have to try something else. So having said that, I think it's high time people consider what's best for them. Remember, what works for me is not what works for you. So this is just a discussion, and I might not have gotten deep into the real accounting, financial language and everything, but I've just tried to simplify the whole process for someone who is looking at the mortgage aspect at face value, so that you make slightly informed decisions without going into the nitty-gritties of facts and figures. So having said that,